Alright, so wanted to make a quick video now that the national debt has hit 28 trillion. It took a while to hit 28 from 27, but as you can see, there's no intention to ever pay this back. It's going to be inflated away. Every day, every week, more and more people in the world catch on to that, and how the dollar is not going to be a safe haven asset, as the policy is clearly to inflate away the debt. Warren Buffett would agree with me if you read in between the lines. Now, this came out February 27th, last Saturday. And he warns that fixed income investors face a bleak future. Bonds are not the place to be these days. Recently, we've been seeing the 10-year Treasury rally up. Let's see if I can get it. One second. Alright, so today it's up a little bit, but oh my god. So as you can see, 1 year bonds spiking. 5 years though, you can see that they're just going back up to pre-COVID levels. Now, this is spooking all asset markets. It's spooking gold and silver, it's spooking real estate, it's spooking anything from Tesla stock to Walmart. It's spooking everything, because when interest rates are practically zero, there's no opportunity cost to investing your capital outside of cash. See, if there's actually an interest rate to cash, then cash will pay you something to hold. So now that cash might start paying something to hold, it's putting pressure on these assets. Now, of course, the Federal Reserve knows, and people in the know that because this debt is so high, 28 trillion, if this goes up even 1%, it's like, I don't know, like 280 billion a year in tax revenue for every 1% that this goes up. So our country can't afford that. It would hog up all, if interest rates were to go up to historical norms, say 1995, 6.45%. If we had to pay that on our national debt, it would hog all of our tax revenue and we'd be done. So the Federal Reserve is going to come in and be the buyer of last resort and buy these piece of crap bonds. Because no one in their right mind, you gonna loan money to the US government for 10 years at 1.465% a year? Like, you must not respect your capital or hard-earned money very much if you're willing to do that. So the only buyer is someone who doesn't have to work hard for the money, someone who prints it out of thin air, and that's the Federal Reserve. Other central banks, of course. Now, I think even Australia's central bank a day or two ago came out and increased their buy and bond purchasing. So these central banks work together in tandem, and they take turns depreciating their currency to almost prop the US up, because it's like the world reserve currency. And if the dollar goes down, it's going to take a lot of people with it. Not everyone. Certain countries, like developing countries and Russia and China, maybe not China, but certain countries would benefit from a collapse in the dollar. The East's long-term foreign strategy or foreign policy is stay quiet until the dollar dies. That's what I think they're doing. But Warren Buffett believes that It's worth noting interest rates have been trending lower for 40 years. This doesn't go back that long, but it goes back through my lifetime and a little more. As the yields have been going down the last 30 years, the price of the bond has gone up. As yields go down, price goes up. So bonds have been in a bull market my whole life, arguably making it the biggest bubble there is, more than the stock market, more than anything, more than Tesla even, I dare to say. Maybe not Tesla. So the Federal Reserve is going to come in and buy these, or some other central bank, and it's going to push the yield back down because they don't want to have to pay any interest worth mentioning on this insane debt. Warren Buffett said, "Can you really believe that the income recently available on the 10-year U.S. Treasury bond, the yield was 0.93% at year end?" Yeah, around there, ish. Had fallen 94% from the 16% yield in 81. 81. No. Yeah, it kind of goes up 15. So this rate of return on the yield had fallen 94%. In certain and large important countries such as Germany and Japan, investors earn a negative return on trillions of dollars. So fixed income, if you have a pension fund or you're a retiree relying on Social Security, this could greatly hurt you. So, we might be trending away from that typical 40% portfolio to bonds, like zero. So let's check out Peter Schiff's tweets because he's a genius. So there's talk of a wealth tax, the most harmful tax that could possibly be enacted on our society, because you want to incentivize the growth of capital and the investment. He made a podcast recently saying that the government should finance itself through sales tax because you get more of what you subsidize and less of what you tax. So we don't want income tax that incentivizes people to work less, and we don't want capital gains or wealth taxes because that incentivizes people to spend their money instead of invest it. Now, modern academic economists will have you believe that spending grows an economy, but it's the savings and investment. If no one ever delayed their gratification, if everyone always consumed all their income, we would not have any capital and we would still be in caves. So it's likely by the end of the Joe Biden term in 2025 that the U.S. debt will exceed $50 trillion. Gold is temporarily hated. I think it's a buy. Specifically, I was looking at Yamana Gold. Yamana Gold, Canadian-based gold, silver, and copper mining company. 2.5 dividend, 5 billion market cap. Super cheap. The downside risk at this point is negligible compared to the upside gain. I like to buy assets when people are afraid, not when they're greedy. People are afraid of gold now. It's been getting beat up this last 6 months. If you look, statistics, 4.56 book value a share. Find me a company that's like not in Russia that's selling for less than its book value per share. Check this company out. Another thing, Netflix is launching Fast Laughs. It's like a TikTok copy. So we'll see how that goes. You know, I think it's going to die. I mean, you can't really, like, I don't think these people are going to offer anything really that Instagram doesn't, and I think Instagram is, and TikTok are where everyone's at. So we'll see how this ends up, but looks like Netflix is trying to get in on that social media kick. Just a quick review of the market. You can see that the NASDAQ is under some pressure. Down 3.28% on the week, just 2% today. Gold, silver, just getting beat up. Gold, in the last 6 months, is the most beat up commodity. Unprecedented money printing, and gold is the most beat up commodity in the last 6 months. Now, I think that's largely because it just ran up too much in 2020, and so there's correction, but still, I mean, gold was undervalued at 2,100. Like, considering how much money they're printing, can you consider this shit? I mean, at the time I started recording this video, I mean, this shit probably went up 20 million bucks. I don't know, I have to go back and check it, you know, but I mean, this is just funny money, man, that people are using at this point. So gold's hated for no reason. The deficits are higher than ever, with no hope of them ever like coming down. This government's going to spend money like crazy. I mean, they might raise taxes, but not nearly enough to match how much they're matching and spending. So 28 trillion. Warren Buffett's negative on bonds. Follow Peter Schiff on Twitter. We'll see how Netflix, let's see how their social media thing goes. Let's watch this 10-year Treasury. It's pretty much what everyone's watching right now. You know, this is why gold, silver, and the stock market are under some pressure right now. So we're basically playing chicken with the Fed or the central banks and saying, like, we know that they're going to come out any day, any week, especially if there's more bloodshed in the market, and they're going to say, we're announcing a new purchasing bond program thing, and they're going to, like, increase their bond purchases by another, like, 200 billion a month or some shit, you know, and this will send, you know, the yield, the price of the bond up, the yield down, and now we can afford to service our debt because the interest rates are less than 1% again. So that's it.